Right. Good afternoon, everyone. Welcome to our webinar. Today, we are going to talk about the application of cost approach, focusing on functional and economic obsolescence. Our presenter today, I'm going to read his profile, is Douglas Kriesa, a fellow with ASA and a fellow with RICS. Has performed evaluation for over 36 years. He is managing director of Valcon Partners Limited. He is a past president of American Society of Appraisers, the past chair of the board of examiners, has served on the MTS committee and on various committees and task forces for both the ASA and the Appraisal Foundation. He has been teaching and writing ASA courses, webinars, and presentation for over 18 years. The majority of his career has been spent performing valuations for financial reporting, ad valorem, tax and litigation purposes. Mr. Kriesa has performed and supervised valuations throughout the United States, Europe, Asia.
Baruka froze on us here.
Yeah. Douglas is regarded as an expert witness and has testified in several states regarding personal property tax matters and in federal bankruptcy courts. In addition to authoring articles for various value-related publications and being a contributing author to various textbooks published by the ASA, he has presented at national conferences on a variety of valuation and regulatory related topics. Mr. Kriesa is a fellow of ASA as well as fellow of the Royal Institution of Chartered Surveyors. Before I hand over to Douglas, I just want to give you some housekeeping issues. We have got an icon at the taskbar at the bottom. There is interpretation. If you want to hear this presentation in Arabic, just select Arabic. If you want to hear the presentation in English, you just select English. Over to you, Douglas.
Ruka, thank you very much. Ruka and his team, everybody at Taqeem has been absolutely fantastic in getting this webinar set up. I really appreciate all the help that all you have done over there. I realize it's the end of your business day, so I appreciate you spending time with me today. We've got about 2 hours. Now, I've got a lot of data that I'm going to be going through, and I'm hoping to get through all of it. If I don't, you will be getting a student manual. And Ruka said that should be available sometime late June or very early July. Yes. So you will have all of this data that I'm presenting to you in a format. It is currently in English. It's currently being translated over to Arabic. So if we don't get through everything, the last part of this is actually a case study, which if we go through it, that's great. If not, there will be enough detail within the student manual that you should be able to figure it out. And in case, for some reason, you can't figure it out, here's my contact information. So please feel free to contact me if you have any questions. Because of the difference in the time, the time difference that we have here, email is probably the best first contact for me. So if you want to email me at that email address, and then if we need to set up a Zoom call or a meetings or something to chat, that'd be great. So I really appreciate the opportunity to speak to you today. This is about the second or third webinar I've done for Taqeem. Taqeem and I have got a pretty good relationship going in the past. Ruka and I have worked together for the last several years on various things at the American Society of Appraisers. So let's just dive into this. What are we going to be accomplishing today? Well, we're going to go over depreciation. We're going to kind of just revisit and make sure that you understand the cost approach. We're going to dig pretty deep into functional and economic obsolescence and what that is and how you can identify it and give you a couple of tools. We're going to go into two tools, excuse me, pretty deeply that show you how to quantify this. And one is called excess operating cost, and the other is inutility. And then, like I said, if we have time, we're going to get into a case study. So there are basically different types of depreciation. Now, for those of you who have taken the ASA courses or the Taqeem courses, a lot of this should be reviewed to you. I understand that some people on this webinar, there's, I don't know, maybe 50 some people on this webinar at this point, 40 something. Some of you may be real estate appraisers and not MTS appraisers, but in a lot of respects, you have the same obsolescence. You've got physical deterioration, you've got functional obsolescence, and you've got economic obsolescence. Now, for those of you, again, as a review, this is the order that you take your depreciation in. You always start, and I'm going to talk about this in a second, but I'll just go through it and then we'll talk about, I'll go through it mathematically and then we'll talk about it afterwards. Reproduction cost less excess operating costs gives you replacement cost. In the cost approach, you pretty much always want to start with your replacement cost. That is the starting point. Sometimes you have to start with reproduction cost, but you always have to start with replacement cost. Then you take off physical depreciation, then you take off functional obsolescence, and then you take off economic obsolescence. Always understand that you take them off in this particular order. You want to make sure that you do them in this order all the time. Now I've got a little note up here that excess that this should not say excess operating cost. I apologize. That should be excess capital cost. So excess capital cost. So reproduction cost new minus excess capital cost equals replacement cost new. So excess capital cost is functional obsolescence. That is the only obsolescence you take off at the beginning of your calculation. So just keep that in mind. And the main reason for this slide, again, is just to make sure that you understand that you take them off in this order: physical, functional, and economic. Now, we're also going to introduce to you the terms curable and incurable, and I'll talk about those later. But curable depreciation or curable obsolescence is something that you can fix. Incurable is something that you cannot fix. Now, just keep this in mind as we move forward, that typically when we talk about curable or incurable, we're talking about physical and functional. For the most part, and we'll talk about why later, economic obsolescence is not curable. You typically cannot fix it. Now, I'm going to go over this chart, and I really, really, really love this chart. And this chart itself, the physical chart, is probably 30 plus years old. I've tried to figure out how to make this into Excel just to make it look better and newer with colors and things, and I can't figure it out. But in essence, what this does is this kind of just visually shows you how things change over time. Now, for explanation purposes, and this is not always the way it goes, but we're going to assume that physical depreciation is just a straight line depreciating at a certain percentage per year. If it's 5%, 10%, 15%. I see something up in the Q&A. I just want to make a comment. I apologize for not saying this up front. Ruka is going to be monitoring the chat and the questions. So if you have any questions, please type them into the chat or the Q&A, and then Ruka's got my permission to interrupt me with anything that he feels needs to be talked about. So let's just assume that physical depreciation is a straight line, just for purposes of this graph. That doesn't always happen. Yes.
Okay, thanks, Bassem. Everyone, if you want to hear Arabic translation, please select on the icon at the bottom on the taskbar. There's an icon written interpretation. Click on that one and select the language that you want. There's English language and there's Arabic language. If you want Arabic, select Arabic. If you want English, select English. Thank you.
So I've got something, and maybe at the end of your taskbar, mine says more, and when you click on that, then you get the interpretation selection. So possibly you might see that as well. I don't know. That might just be because I'm a presenter. So hopefully we'll get that straightened out. If not, I'm sure this is being recorded in Arabic, so maybe you can watch it again later. So let's get back to the graph here. Let's assume the physical life goes down at a certain percentage, 10 or 15 or 20% per year. Functional obsolescence, the reason that it is shown as kind of a step here, you get functional obsolescence and then it goes for a period of time. And the reason that is because typically functional obsolescence happens when, I'm going to call it, a family of products gets released. So I'm talking to you on a laptop. I'm talking to you on my Lenovo laptop. So Lenovo will come out with a certain laptop, and then they'll have that same laptop for a number of years. And then they will come out with something that's a different style of laptop that might be more efficient, might have more memory, might have more hard drive space. So these lines represent families of products. So until a new family of product is released, the functional obsolescence stays the same. This is very typical of medical equipment. This is very typical of high-tech equipment, where a family is released and the technology stays the same, and then something new is released that causes additional functional obsolescence. So that's why it's represented as a step. Economic obsolescence is kind of a very unpredictable. You could sort of predict physical depreciation. You could predict functional obsolescence. Economic obsolescence is stuff that happens on the outside of the asset. It's influences from external sources. It's something that's very difficult to predict. The reason there's this gap here is there's something that we appraisers call the penalty of ownership. So the reason economic obsolescence has this drop is the moment you as the purchaser buy something used, even if you never use it, it is still considered used. So therefore, it always drops in value a little bit, sometimes a little bit, sometimes a lot. For those of you who may have just bought a car recently, sometimes that drop can be very, very hefty. You drive the car around the lot, you take it back to the dealer and say, I want to return this car. They're going to give you 15 or 20% less than you paid for it because of that penalty of ownership. Now, we're not going to dig really deep into physical deterioration, but I just wanted to help you understand it and make sure you understand what that is before we move forward. So physical depreciation is a loss in value within a structure, so within a piece of equipment or a structure arising from wear and tear over time. So primarily, it's wear and tear, it's deterioration, exposure to the elements, physical stresses, that type of thing. It's something that you can fix. So here, these are some examples: deterioration from age, fatigue, wear and tear. I'm not going to go into great detail here because that's not what we're going to be talking about primarily today. So typically it's estimated at somewhere between 0 and 100%. If something is 100% physically obsolete or physically depreciated, then it's pretty much ready for the scrap heap. So it's often an estimate based on a percentage. It's usually, and for those of you who've taken the courses, it's a percentage of effective age divided by normal useful life. And again, I'm not going to go too deeply into that because that's not what we're going to be talking about. I want to get into the two types of obsolescences that I was asked to speak about today. First of all is functional. Second is economic. Physical depreciation is typically pretty easy to figure out. I mean, that's something that you can pretty easily recognize. It's something you can usually see. Maybe when you're walking around a piece of equipment, you can even smell it. If something's burning or something doesn't smell right, you can see it. If you got a piece of equipment that's in really bad physical condition, or there's fluid all over the place, or there's oil all over the place. You can hear it. If you hear an engine grinding, if you hear the motor struggling to operate, those are physical issues that you could very easily see. Functional obsolescence is a little bit more difficult because you really can't see it. It's inadequacies or inefficiencies built into the asset that are not physical in nature. So here are some things that you could, again, you can't see it by looking at the piece of equipment, but you can see it in other ways. So the piece of equipment might have a lack of utility. It might not be producing at the same rate it did when it was new. It might have excess capacity. It might have been designed to do 1,000 units per hour. It's only doing 500 units per hour. There might be improvements in design. So the manufacturer has come up with something new, something that's better in design. It's more efficient. It's technologically advanced. So those are things that, again, you can't see them, but you can recognize them. And how do you recognize them? You have to talk to the manufacturer itself. So talk to the manufacturer of the item. I just did that recently. I was working on a product. These particular pieces of equipment were made anywhere from 8 to 10 years ago. And I talked to the manufacturer and I said, have you come up with anything new or better? And they said, well, actually, no. Those models are still being made. They have a different control system on them now, but there's no improvement in design. They're just as fast as the new ones. There's not a lot of technological change except for the difference in control system. So that helped. So you can talk to the manufacturer, you can talk to your client, you can talk to the company that's actually using it and say, is there something new that you know of that's coming down the pike that's a little bit more efficient, either in energy or better in materials or something of that nature? Economic obsolescence, on the other hand, so we talked about functional obsolescence being internal or something that's in the asset itself. Economic obsolescence is external. So it arises, and this is IFRS and IAS 16, it arises from a change in the market demand for the product or service output of the asset, or due to legal or similar limits on the use of the asset, such as the expiry date of related leases. That last part I'm not going to go into too much because that's not very equipment related. It's more leasehold improvement related. But just keep in mind that economic obsolescence as external. Now, in the English language, economic and external both start with the letter E. So that's how I usually tell my students to understand it. As functional as internal, sorry, don't have any good tool for you to remember that. But economic obsolescence and external start with the letter E. So again, just remember that's something that's external. So here are some different things that you can look at. Again, external or economic obsolescence is not something you can just see. So here are some examples. Management concepts or abilities. So can the management of a company influence negatively an asset? Absolutely. Availability or lack of raw materials. So if there's a lack of raw material availability, that could cause economic obsolescence. If you don't have the proper or properly trained labor supply or a labor pool near you, that is something that's an economic obsolescence factor potentially. Market accessibility or acceptability. The acceptability is a big part. So is it something that the market wants? If the market does not want it, then it becomes less acceptable, it becomes less popular, and that's an economic obsolescence factor that you need to consider. Regulations from a government entity. I don't know about Saudi Arabia, but we have got a ton of agencies in the US that love to regulate governments or love to regulate businesses. And they say, you can do this and you can't do that. So literally, the government could create economic obsolescence overnight by saying you can no longer do this process, or you've got to change something to do that process. Earning power, what we mean by that is something, whereas, you might be making a profit one day and all of a sudden you're losing money the next. That is economic obsolescence. Competition. If somebody comes into the marketplace and competes with you and creates an item that's better but cheaper and more efficient, That could be economic obsolescence. Product demand and economy, that's another thing. So just want to keep that in mind. Now, we talked a little bit about curable and incurable, so now I'm going to define exactly what that means. So curable obsolescence or curable depreciation is obsolescence or depreciation which is economically feasible to undertake. What does that mean? What that means is that you can fix it, you can put some money into it. Number one, you can say, I know exactly how much it's going to cost to fix that. Number two, so there's really a two-pronged test for curable. Number one, you can identify how much it costs to fix. Number two, it makes sense to fix it, meaning that if I'm going to put $50,000 into this piece of equipment, I'm going to get more than $50,000 worth of benefit over the life of that piece of equipment. And we'll hopefully get to an example later where I show you how that works. Incurable is not economically feasible to undertake. Either one, you can't figure out how much money it costs to fix it. Number two, no matter how much money you put into it, you can't fix it. Or number three, you know it's there, but you have no other way of quantifying it. So keep in mind that curable obsolescence or curable depreciation, you take a penalty based upon a dollar or a SAR figure. So you take it based on some sort of currency figure. Incurable, you do as a percentage. So curable, you calculate the cost to cure, or think of the cost to cure as the cost to fix. How much does it cost to fix this? And you can take that off as a direct dollar. So if you've got something that's $100,000 brand new, it's not operating properly, but for $10,000, you could change out the controls and you could bring it back to 100% of its capacity, then you know that the penalty is $10,000. Incurable, again, is based on a percentage. And again, primarily curable, you can have physical depreciation that's curable. You can have functional obsolescence that's curable. You typically cannot cure economic obsolescence because usually that is outside of the influence of the owner of the company. So now we're going to take a deeper dive into functional obsolescence. We've already kind of went over this a little bit. Just kind of want to give you a review. This is a picture of the interior of a Doosan TT1500 SY CNC lathe. And the reason it's an interior picture is because functional obsolescence is something that's inherent or inside the asset itself. So why does functional obsolescence exist? Functional obsolescence exists because a newer asset using modern technology has operating advantages compared to the older obsolete asset. So if you have two assets and you have a 10-year-old one and a 5-year-old one, and they are technologically the same, there's no difference. You might have physical depreciation, you might have economic obsolescence, but you will not have functional obsolescence. Now, if you have two pieces of equipment, let's take my laptop, for example. Over the years, I've had many, many laptops. Why do I keep buying new laptops? Because they're faster, they're more efficient, they've got more storage in them, all that type of thing. So they improve over time. Computer numeric controlled or CNC equipment, that does the same thing. You might have a piece of equipment that at one point was manual and now is computer operated. The computer operated machine means, guess what? Less labor, probably more efficient, probably more energy efficient. Those are all functional issues. So functional can really be two things: technological, where they're technological changes, or where they're functional changes that were introduced. So functional obsolescence is due to things like a new machine. So think about this as comparing an old machine to a new machine. So the new machine has got faster speeds. They can produce the product at a lower cost. The machine might be more energy efficient, might have better control over the tolerances. So if you've got to have a piece of material that's machined to a certain tolerance and an older machine cannot do it, that could be a functional issue. So how do you measure functional obsolescence? One of the things you looked at, and we mentioned this a little earlier, is excess capital cost. So if you remember your definitions from either your Taqeem courses or your ASA courses, there's reproduction cost new and replacement cost new. And we will go into that more in the next slide, but typically reproduction cost new is greater or more expensive than replacement cost new. So if you could build a new unit cheaper today than you could build it, reproducing it, that's a potential functional obsolescence. That's called excess capital cost. Then there's excess operating cost, and don't mix up the two. So excess operating costs are things like, is the new one more energy efficient? Does it take less people to operate? Can it make a product faster or cheaper? So we talked about this already, that reproduction cost minus replacement cost gives you excess capital cost. So just remember that that's called functional obsolescence. So we're I'm kind of repeating this a lot, but the reason I'm repeating this is I want to make sure that you understand it. So functional improvements could be cost efficiency. Is there the new machine? Does it use less energy? Does it use less labor? And this is something that people don't always understand. Maybe it's got less scrap. So maybe the new machine, instead of a scrap rate of 15% of every piece of material that goes through there gets scrapped, maybe only 5% of the material that goes through there gets scrapped. So if they come up with a way to create a more efficient and create less scrap, that creates a cost efficiency, and therefore the older machine that creates more scrap is more functionally obsolete. So see, this gets pretty deep. Maybe speed or capacity. Does the new machine create something faster? What's the benefit of creating it faster? You can create more parts per hour. If you can create more parts per hour, what happens? Your profit level goes up, right? Maybe it's more accurate. Maybe there's a design issue. Maybe, this machine used to take up, think about, I don't know how old everybody is on this webinar. And we've got, at this point, almost 80 people on this webinar. I'm assuming we've got people from brand new to the industry to, old people like me. When I started college, a computer that could pretty much replace my laptop used to take up an entire room. Well, now I can do a lot between my computer and this cell phone over here. I mean, I've heard rumors that there's more power in my cell phone than there was in, the Apollo missions going to the moon. So therefore, instead of having to take an entire room and create all this infrastructure to have all these servers, you could now do it, on a laptop. So that's a design and a less space issue. Now, that's pretty dramatic, but you do have that happen with equipment as well. More versatility. Do you have a machine that instead of doing one thing can do 2 or 3 things? Is it, instead of being just a lathe, is it a lathe and a machining center built into one? So there's revenue impacts. So a newer piece of equipment would have increased per unit output. So in other words, they have a greater output, they reduce the cost, or they have better quality or precision. So we've talked about this, but again, I just want to make sure you understand it. So expense impacts, is it increased energy? Is it better for the environment? That's a whole nother thing. Why does something being better for the environment create functional obsolescence? For example, the water bottles that everybody uses. I mean, I remember back when the water bottle was, very solid and it was a very thick piece of plastic. Well, now you grab them and they irritate me because they're so, very thin. Well, what happened there? It's less of an environmental impact. And so thus the ones with the cheaper bottles became more attractive to own or to use. So therefore they became more popular. So these are just some things you want to consider. It doesn't have computer numeric controls, which allows, instead of, 1 person per machine, allows you to operate 5 machines with 1 person. Are they more energy efficient? Capital cost, do they take up less space? Are they cheaper to build? Those are all functional obsolescence issues. We talked a little bit about functional obsolescence can be curable or incurable. It can be fixable or not fixable. If you want to think about it in those respects, fixable is curable, not fixable is incurable. And remember that curable depreciation is always taken as a dollar amount or a SAR amount or a currency amount, whereas incurable is pretty much typically a percentage deduction. So how do we actually implement this? So let's go over an example. So you've got a machine here that is designed to produce 2,000 units per hour. The cost of that machine is 750,000 SARs due to an issue with the control system. So since it's the control system, that's internal to the machine itself. Because of this issue, it can only produce 1,500 units per hour. The cost to fix, the cost to purchase another piece of control system that they can fix it is 75,000 SAR. So what's the penalty? So we're going to show you two different ways to calculate the penalty, and then we're going to talk about what is the best way to actually apply the penalty. So the first issue is that if you take 1,500 units per hour, which is what it's producing now, divide it by its capacity, therefore it's only operating at 75% capacity. So you could say that there's a 25% functional obsolescence penalty because of the fact that it's only operating at 75% of what it could be. So if you take that, you take your 750,000 SAR times 25%, gives you a penalty of 187.5. You subtract that off and you get 562,500. However, you know from talking to your client that for 75,000 SAR, you can fix that. And this will restore it back up to that 2,000 unit per hour. So the penalty brings you up to 675,000 SAR. So you've got an option, as the appraiser, you've got an option of 563,000 SAR or 675 SAR. Which one do you pick? Now remember, as an appraiser, you're supposed to be independent, you're supposed to be unbiased. So it's not which is the better answer for my client. That is not the answer. And trust me, if we were live, I'm sure I would get that from somebody in the audience. Just keep in mind that the penalty that you take cannot be greater than the cost to cure. The penalty that you take cannot be greater than the cost to fix the asset. So now let's take that same problem and let's look at it from a little different scenario. You got the same issue, everything's the same, except instead of 75,000 SAR to fix, it now costs you 250,000 SAR to fix. So we know that our penalty of the incurable is 187,000. Our penalty to fix is 250,000. So in this case, which one do you choose? In this case, it's not as clear. So what you've got to do is you've got to go back and you've got to look at why is this penalty here? Why does it cost so much to fix? And you have to do a little bit more investigation. I would probably lean towards this answer in that case for the most part, unless I had something that specifically said this is the best way to go. So if the cost to fix is greater than the utilization penalty, then you've got to do more investigation. The way I look at it typically, and again, I never go above the cost to cure. This is my personal opinion. This is not ASA's opinion. This is not even in a textbook. But my opinion is I always take the smaller of the two. That's just my personal opinion, because that's how I would look at it as a buyer. One of the things I always tell my students, and this is something that I was on the phone with somebody the other day, they were taking an online course and they called me up and they were struggling with the cost approach because this person was primarily a dealer and they really didn't use the cost approach and they were really struggling with it. And I said, when you're doing an appraisal, pretend you're the buyer. Pretend you're purchasing this piece of equipment. How would you think? What would you do? How would you consider the value? And his light went on in his head and he said, I've always thought about it from the seller's perspective. From the seller's perspective, what would I want to get? And I said, no, turn that around. Look at it from the buyer's perspective. If you're doing an appraisal, you're acting as a buyer. What would I pay and why? So that's why you got to consider this. Let's take a little dive into economic obsolescence.
Can I interject, Douglas?
Yes, Ruka, go ahead.
Yeah, on the issue of functional obsolescence, for example, let's take that I've calculated and I've seen 25% based on the capacities, differences in capacities.
Yes.
Yes. Is it deductible once or over the remaining life?
That's a Ruka, that's an excellent question. So when you're calculating this particular penalty, you take it one time. Now, I will show you a penalty that you calculate over the life of the asset, but you still only take it one time. Now, I think the question Ruka is kind of asking is, does this penalty exist going forward? Is that the question you're going to ask?
Yes, because for example, I've got a cement plant, and I'm advised that it is working under capacity like that, right? Instead of working at optimum 2,000 units per hour, it is working at 1,500.
Yes.
Of which it's a penalty. And my question is it deductible for the valuation that I'm doing, for the period that I'm doing, or it's spread over the number of remaining useful life?
That's an excellent question. So think about this. Whenever you do an evaluation, you're doing it as of evaluation date. So if you were doing multiple valuation dates, let's say you might be doing, 2 or 3 in the past and the current date and 1 and 2 in the future, you've got to do this calculation for each one of those dates, and you need to calculate something different. So it's only taken once, and it's only taken for the valuation date that is applicable. Now, over time, could that change? Yes. So the penalty, maybe, if let's say you're doing, for some odd reason, you're doing evaluation last year, this year, and next year. Last year, let's say they were at 90% capacity. So you'll take one penalty for that date. Right now, they're at 75% capacity. But let's say they know they're going to fix it so that, next year they'll be at 95% capacity. So you've got to kind of figure that out. So you take one penalty per valuation date, if that makes sense.
Okay, thank you very much. Quite clear. But can I just add another question on? It's almost similar to that.
Yes.
Like for example, during inspection, you might be given a schedule of annual productions. Would you consider them? Because, for example, over the past 2-3 years, the capacity has been 60, 65, now it's 75. Would you consider that, or it's something that you have to consider the current capacity, production capacity?
Yes, I would. So just that, and Ruka, again, that's an excellent question. You've got to consider the capacity as of the valuation date. Now, let's be careful on that, because let's say, again, you're doing an inspection, and let's say for some odd reason, the plant on that particular date is only operating at 20% capacity. Let's say you show up on a holiday or you show up on a day where they're not producing a lot. You're not going to take that much of a penalty. I always take a look at what were you doing in the past? What are you doing right now? And kind of where do you think you're going in the future? And I kind of blend all those together. Now, if there's a particular reason that as of today, like you said, Ruka, 2 years ago it was 60%, then it was 65, and today it's 75. Or let's take it the opposite way around. Let's say that 2 years ago it was at 75, and then it was 65, and then 60 today. If there's a good reason why they're at 60, and if that trend is actually because of a certain, probably either economic or functional obsolescence factor, I would take the exact one at the date of analysis. Now, let's say again, if you're sitting there, on a date and they're operating at 20%, but tomorrow they're going to be operating at 95%, I wouldn't take that penalty, because that's too much. But you've got to kind of put it into perspective of what else is going on around that date. I mean, I know valuations are as of a date, but you've got to kind of say, why are they at that? So I was on the phone with somebody the other day, and I was telling him what I was doing, and he says, "You're not being an appraiser right now, you're being a detective." And that's very true. You've got to do a lot of research. It's good to, like Ruka said, it's good to get the past history and where they expect to go and see if that downward trend is continuing, or if the date that you're there, there's an unexpected deal. You've got to kind of look at the data. Now, I'm being a little bit, I'm not really giving you a distinct answer because there is no distinct answer, but I would weigh, this is the way I would look at it. I would look at past production. I'd look at future production projections. I would heavily weigh what's going on the date of your inspection or the valuation date. I would heavily weigh that. And then I would give less weight going out, if that makes sense. Maybe it's not very clear, but that's what I would do.
Thank you very much, Douglas. Well
Okay.
explained and answered.
Okay. So again, we talked about some of the economic obsolescence issues. This is the exact same machine we just saw the internals of, but now you got arrows pointing in because these are things that are influencing the value of the machine from external purposes. Remember, economic is external. So there's different ways you can measure it. You can use an income approach. Now, I typically do not do an income approach because I'm not smart enough. Income approach kind of confuses me at times. So if I usually have to do an income approach, I will work with somebody like a business valuation person, or there's a couple other people that deal in this that are really good at that, and I will work with them to get it done. But an income approach is one way to figure out economic obsolescence. Another way is the cost approach. Now, we're going to look at a couple different things. We're going to look at how an income approach can influence your economic obsolescence factor. That I do understand. We're going to talk about inutility. Here are some other methods, and I'm not going to go into these methods, but if you get the appraising machinery and equipment textbook put out by the ASA, each one of these is covered in that textbook in some pretty good detail. These are lesser used, but they are ways of potentially looking at economic obsolescence. I've used some of these in the past myself. But we typically, the reason I'm going to talk about the income approach and inutility is those are probably the two most utilized ways to come up with economic obsolescence. So I alluded to this earlier. Economic obsolescence typically cannot be fixed. And why I say it cannot be fixed is typically it's outside of the influence of the owner of the asset. They cannot change it. Typically, that's something that'll help you understand, is this functional, physical, or economic? If they can fix it, it's probably in the realm of physical or functional. If they say, and I'm saying I'm talking about the owner of the company or the owner of the asset or the manufacturer of the asset, if they say it's out of my control, I can't do anything about it, then it's probably an economic obsolescence factor. One thing to consider is, let's say you're doing a three approaches to value. You're doing a cost approach, you're doing an income approach, and you're doing a sales approach. Now, economic obsolescence is inherent, which means it's already considered in the sales comparison approach. It's already considered in the income approach. So if you're doing those two approaches, do not take any other additional economic obsolescence off the top. Why is that? Because again, what did I say earlier? Your idea when you're doing an appraisal is to consider what would a typical buyer do. So if somebody's looking to buy something and there's an asking price out there and there's a negotiated deal to buy that, they're already considering all the factors that they would pay for that. They're considering the physical depreciation. Now, they might not be thinking this way because a buyer doesn't think in those terms. Those terms are valuation, terms. But they're thinking about, how old is it? How worn out is it? Is there something out there that's going to be better technologically? And what else is influencing the value of that asset? So when they're buying something or when they're asking prices, those are already considered. So just be careful and make sure that if you do that, don't take it off again. I actually had a situation where I was reviewing an appraisal many years ago. They did the market approach and then they took off economic obsolescence again. And this was somebody that was very well respected in the appraisal industry, and I couldn't believe that they did that. But unfortunately, they were doing it because they were biased towards their client, and I proved it to my client, and they were not happy. Economic obsolescence. Economic obsolescence is most variable. It changes all the time. Physical depreciation typically goes downward unless something gets fixed. And when it gets fixed, then you move up a little bit, you get better condition, you get less wear and tear. Functional obsolescence, you could change controls, you could do things, you can sort of predict where you're going. Economic obsolescence is not predictable, and it changes. It can appear and disappear quickly. It can be there one day and gone the next. It can be temporary, it can be permanent. So sometimes it's there, sometimes it's gone. It's very volatile, and it's really the hardest to figure out. It's hardest to quantify. So here are some things you need to look at. Number one, does it exist? What is causing it? Is it internal or external? So knowing these questions will help you decide, number one, is there obsolescence? And number two, is it physical, functional, or economic? What is causing it? Is something causing it because it's wearing out? Then it's physical. Is something causing it because there's newer technology coming out? Then it's functional. Is it causing it because, I want one or I don't want one? Then that's economic. Answering what will cause it will guide you to the appropriate method to identify and how to quantify it. The other question that I'm going to add here is, can I fix it? Obviously, that gets into the curable versus incurable. So in the cost approach, economic obsolescence is included as a separate adjustment. And remember, you always go physical first, functional, and then economic. So again, we talked about this, that a sales comparison approach and the economic and the income approach, it's already captured. So let's say that, you're doing evaluation and, let's just assume you're a lazy appraiser and you say, well, I'm just going to assume there's no economic obsolescence. And I would never call an appraiser lazy. But I have seen in reports that, we did not consider economic obsolescence, and they'll give some reason for it. And usually the reason is pretty, I don't know if you know what the word lame means, but lame means that it's not a very good reason. It's just something to kind of say, well, we didn't want to do it, so we didn't do it. So what are some of the problems? If you're doing, and I know a lot of people on this call are doing purchase price allocations and financial reporting. So these are some things that if you don't consider economic obsolescence could be an issue. Number one, it could overvalue the fixed assets, which could be a problem going forward for impairments. Depreciation expense could be overstated. Income could be understated. May result in unexpected impairments later on. Could be impacts the value of the intangible assets, because as the value of the fixed assets go up and down, the intangible assets go up and down. Results might understate goodwill. Again, I'm not going to go into too much about that. I gave a webinar a little while ago on allocations of purchase price under IFRS, and that's probably up on the website somewhere or somewhere you can see that. But we go into kind of what goodwill is, but you definitely do not want to under or overstate goodwill. So there could be a lot of different factors that could cause economic obsolescence. I'm spending a lot of time on this, even though I'm saying it's the hardest to quantify, because it is the most confusing. So there could be economic factors. As the economy goes up and down, economic obsolescence comes and disappears. So as the economy gets worse, the machine values have a tendency to fall. So as the economy gets better and worse, it could influence certain industries or certain sectors. So there's economic factors. It's what's going on in the total economy. There's industry factors. I can only talk from what's going on in the United States right now, but there's a huge push towards electric vehicles. So there's a push that electric vehicles are theoretically getting more valuable and internal combustion engine vehicles are becoming less valuable. At least that's what our government's trying to tell us. And I'm not going to get political here, but I will tell you that I've been kind of looking for a different vehicle right now, and I'm looking towards towards a gas engine car, and they're still pretty popular and pretty valuable. So, but there are industry factors. But again, that whole influence of the government saying you need to build an EV, you need to build an electric vehicle versus an internal combustion engine vehicle, that's an economic obsolescence factor that you got to take into play. So it could be economic, which is overriding, could be industry, which is a little bit tighter. So it could be the aircraft industry, could be the dairy industry, could be the cement industry, like Ruka brought up earlier, could be the electronics industry. It could be the specific company. There could be something going on within that company I always get asked this question is it possible for the actual, just the company itself to have an influence on the value? And the answer is absolutely. Now, I will tell you that that value influence is really only applicable under fair value and fair market value installed, because once you get out of that realm, the company influence on the value of that asset kind of goes away. So once you figure out what the cause is it economic or industrial or why, then you can figure out, how am I going to approach it? What am I going to do? How is the way that I can actually value this? So what are some impacts? Obviously, if the revenue of the company is going down, there might be economic obsolescence. If the cost of my product is going up, there could be economic obsolescence. If there's increase in indirect costs or direct costs, meaning my materials going up, my labor rates are going up, my power rates are going up, that could definitely be an economic obsolescence factor. So here are some things that you might want to look at. And again, being an appraiser means you've got to be able to ask a lot of questions. So you ask your client, is there a decrease in the marketplace of your assets? Is there a decreasing value of the equipment? Long-lived assets includes equipment. Is there adverse change in the extent or manner in which the assets are being used? Maybe up until last week, this line was operating all of the time. Well, now there's something happened, some influence, and we're only operating at 50%. So are they being used? Or on the opposite end, are they actually maybe get retired because that product is no longer viable? Are there legal factors? Are there business climate factors that could influence the value of the assets? Absolutely. I'm going to skip number 4 because that's a little bit tougher and hard to get into, but are there operating cash flow losses? In other words, are you no longer making money producing this product? Is it possible that you wanted, in number 6, this one gets interesting. This happens quite a bit. You expect the asset to last 10 or 12 or 15 years because you expect to have production that long. And then somewhere along the line, the product is limited to a certain period of years, which is shorter than the physical lifespan. So if that's the case, you have potentially economic obsolescence. So one of the things to consider, and I know this is more pushed towards purchase price allocation, but I'm guessing that a lot of people in this call probably deal with that a lot. But one of the things you got to consider is that the lowest you can typically go is orderly liquidation value. And why is that the lowest you can go? Because that's typically the value at which you could sell the equipment in the open market. And it's the lowest value that you could do so. It's not an auction value. It's not a got to get rid of it right now value, but it's a value that if you had to sell that piece of equipment within a reasonable period of time, you could sell it for that. So be careful when you're calculating your economic obsolescence factor that you don't drop below that. And for those of you who have taken my courses in the past, you've heard me say, and I apologize, my mustache is bothering me. I need to get it trimmed. I apologize. It's itching my nose. That's why I keep fooling with my nose, which I know is not professional, and I apologize. But my wife told me I needed to go to the barber before I did this, but I didn't. So anyways, for those of you who've taken my classes, I say that the cost approach is simply math, which it is. You take a cost and you start subtracting things off. So your math is always correct, but your answer is not always right. So what you've got to do is you've got to investigate what's going on, and you need to make sure that all the numbers are correct. And the best way to do that would be to look at what's going on in the economy, in the industry, and with your particular plant, and make sure that you've got all that captured. And obviously, the best way to do that would be to capture actual market comparables. So I've run into situations with some valuation firms where they take such a huge economic obsolescence factor hit that they take the equipment down to a value that is absolutely ridiculous. So, for example, and I'm not going to give you exact numbers because I don't remember the exact numbers, but let's say the replacement cost of an asset was $50,000. Fair market value continued use was 45. Let's say that you could go to the marketplace and you could buy one for 30. They were saying it was worth $10,000. Well, if you could go out to the marketplace and buy one for 30, I would argue that the lowest you could go is probably 30. With some negotiation, maybe you're down to 20 or 25, but you're not down to 10. So be careful when you apply the math that there's a realistic backdrop for that math. Here are some other things, and again, I'm not going to go into this. And when you have the student manual, you can read these. These are some other ways that you can identify economic obsolescence and quantify it. These are a couple different methods, and again, I'm not going to go into those too much. The income approach. So again, I don't typically do an income approach, but whenever I'm doing a purchase price allocation, somebody's doing an income approach. And what they're going to say is that the value of the company based upon the income approach is, let's say, $1 million. Well, if you come up with, between you and the real estate and the inventory, if you come up greater than $1 million, there's potentially some economic obsolescence. And if it's based on the income approach, primarily it's economic obsolescence. There's some economic obsolescence that you may have not considered. Does it mean it's absolutely there? No. But it's something that if you come up with a number that's greater than the income approach, you might want to go back and look at your assumptions. Are you really considering all of the different factors we talked about appropriately? So that's something you've got to look at. Now, if you're basing your values primarily upon market data, then I would say, I've already considered all my economic obsolescence. I don't have any other issues that I got to hit. But if you've done a cost approach, or if you have assets that are real specialized or very unique, then you may want to consider it. So here are some challenges and we talked about the first one a little bit. Number one is applying economic obsolescence models without confirming that economic obsolescence actually exists. In other words, if somebody tells you, well, we've got 25% economic obsolescence, and you take it, but you don't even, you don't investigate why, that could be a problem. So for example, if a 25% penalty is calculated using one of the models, it does not necessarily imply that you've got to take 25% off of your fixed asset records, so of your fixed asset values. The other thing that I always argue whenever I get this pushback from a business valuation person, hint, I know enough to be dangerous. I've dealt with these guys and ladies for 30 years now. Business valuation people, and if there's some of you on here, I apologize. I don't want to offend you, but you do have a tendency to think that you know everything, which you're very smart people, understood. But you have a tendency to say, well, I came up with this number, so therefore your number must be wrong. You need to reduce your number by 25% in order to make everything work out. And generally, you're sort of right, but not always. So what I've got to do and again, I consider myself a valuation professional. I'm not an appraiser. I'm a valuation professional because I've been doing this, and I consider myself more of a consultant than an appraiser. But I know my assets, and I think everybody on this webinar probably does as well. So you could make the decision: is 25% deduction, does it make sense? Yes or no? Maybe it's a 10% deduction on these assets and a 30% deduction on other assets. Maybe it's 20% across the board. So if somebody comes back at you and says you got to do this because of a cash flow, look at your assets and see if you want to take those deductions. So my point here is, don't just take it because somebody tells you it's there. So let's talk about a case and do a little bit of an example of how the business enterprise value or how the income approach could potentially tell you that you've got some obsolescence. So here's a company. They've got 375,000 SAR of cash and investments. You calculate the fair value of your assets at 1,875,000 SAR. You know that fair market value in exchange or fair market value removal, which means the fair value less all costs of installation and engineering, is a little over 1.1 million SAR. You know that the OLV, so the orderly liquidation value, is 750,000 SAR, meaning if I needed to sell all of the equipment in my plant piecemeal, without an auction, but piecemeal, I should probably get about 750,000 SAR. Assuming that the business enterprise value is 1.5 million, given all of that data, and considering you got 375,000 in cash, what do you think the value of your equipment might be? So is it 1,875,000? It could be, but I kind of doubt it because there's something here that's going on probably with the equipment, with either the business itself or the industry that you're not capturing. So could it be 1.5 million? Yeah. Is that above your fair market value and removal? Yes. Is it above your orderly liquidation value? Yes. But also think about this. You've got 375,000 SAR in the bank. This number includes that. So you've got to subtract 375,000 SAR from that. You end up with about 1,125,000. Oh, look at that. It happens to match that number. So that kind of makes some sense. So it might be that number. Let's take another example where everything's the same up here, but instead of 1.5 million SAR, the income approach says the company's worth 2,155,000. So if that's the case, then you take 2,155,000, you subtract off the 375, you end up with 1,780,000 SAR. Does that make sense? Because it's between these two numbers. Absolutely. Now, does that mean that you automatically take that kind of adjustment? That's up to you being an informed appraiser and being a knowledgeable appraiser is, do you take that deduction or not? To be honest with you, I probably would because the deduction's so small that it fits between my two numbers here and it's a pretty small thing. So I probably would take that. Let's take the third case scenario where everything's the same up here, but then something happens and the company's really not worth a heck of a lot of money. It's only worth 750,000 SAR. Well, that tells me if you take off that, you're at like $375,000. This company's probably not going to last very long. I would suggest that they're probably going to go into bankruptcy unless some management comes in and turns things around. This company's not going to last very long. But if you take 750 minus 375, that leaves you 375,000 SAR to say that's the value of the equipment. Does that make sense? Give you a second to think about that. It doesn't. And why doesn't it make sense? Because I could liquidate the company and all the assets for 750,000. So the lowest I would go in this case is 750,000 SAR. So hopefully that makes some sense to you. Now we're going to go into another problem that gives you kind of another similar situation. So you're involved in the chemical plant and arrived at the replacement cost less physical and functional of 11,250,000 SAR. The BV, the enterprise, the calculation of all the income approach says it's worth $10 million, 10 million SAR. There's 3 million of identifiable tangibles and intangibles. Based on your discussions, the orderly piecemeal disposition or the liquidation value is 500,000 or 5 million SAR. So assuming there's no land and no building, so essentially what you've got is you've got equipment, you've got some cash or some currency. What is the fair value taking into account the economic obsolescence? So how would I calculate that? Well, the first thing as the test is to take your income approach, subtract off your cash. That gives you 7 million SAR. So if you're talking to the person doing the business valuation, you don't want this number, you want this number. You want to know what the implied fair value, excluding what they call identifiable assets, which are cash and stocks and that type of thing. So if this is your value installed, this is your value under piecemeal disposition, you may want to conclude at 7 million SAR. That kind of makes some sense. It's right between the two. It makes some sense there. But again, don't just automatically go to that. Make sure that it makes some sense. So that's one method of using an income approach to identify economic obsolescence. Next, I'm going to show you probably my favorite way to calculate economic obsolescence. And why is it my favorite way to calculate economic obsolescence? Because it actually uses market data to calculate what is the market looking at, what is the reality of what you're looking at under a situation where it's not just math, but you're taking into account what people buying and selling the assets are considering, which is your buyer, and which is what you should be thinking about. So let's say you've got a machining center that has a replacement cost of 1.5 million SAR. You estimate that the physical depreciation is 25%. You estimate the functional obsolescence, that should be FO, not EO, but you estimate that the functional obsolescence is at 10%. So you take off 1.5 million, less your physical, less your functional, you get 1,012,500 SAR. Okay, do you stop there? Well, there's probably some functional obsolescence there, or economic obsolescence, but you just don't know how much. So how do I figure it out? Well, let's say that you go to the marketplace and you find some similar used machines for sale. So this machine, let's say it's a model ABC, you go to the marketplace and you find some ABC models for sale, and they're selling for 810,000 SAR. That's less than what I was estimating. So what do? Is you take your estimate of market value by the cost approach, you subtract off what they're actually asking for it, and you create a percentage. So we're estimating that the economic obsolescence is 20%. Now, do I need to do that for my particular asset? No, because I already know that they're selling in the marketplace for 810,000. So I use that. But how can I use this 20% in my future valuations or my valuations of another asset within this same project? Well, here's how. So I find a machining center that has a replacement cost of 2 million SAR. We estimate the physical depreciation at 10%, functional economic at 10%. We don't know the economic obsolescence at this point, right? So we do our math. We subtract off the physical first, then we subtract off the functional. So we come up with $1.6 million. We know from our previous valuation that we were basically 20% high because of economic obsolescence. So you can take that and you can say, I'm going to subtract off 20% from this particular machining center as well, which comes up with this value of 1,296,000 SAR. So just kind of keep that in mind, that you can use that to value similar assets. Now, here are some of the things that you need to consider. Number one, for simplicity's sake, I just said I have one example and I calculated an economic obsolescence from that one example. Is that enough? Is that statistically valid? That's a great question. I don't know. But the greater the number of pieces of data you have, the better, but you could use it. The second point is that you want to make sure that you're using it only on pieces of equipment that are similar. For example, I would not calculate an economic obsolescence factor for a bunch of forklift trucks and then try to apply that to a bunch of machine tools or to a cement plant or to a chemical plant. I would make sure that I'm using assets that are very similar. Number three, your cost approach has to be handled consistently. In other words, you've got to use the same metrics for calculating physical depreciation and functional obsolescence all the way through your calculation, so that the only variable is economic obsolescence. The fourth one is that the market data has to be at the same level of trade as your concluded value. And what that means, a level of trade, means is this retail or auction value, retail or wholesale. So you need to make sure that you are using similar data. You may hear the term economic useful life out there. Economic useful life is related to economic depreciation, but it's slightly different. So it's the estimated period of time stated in years that a property may be profitably used for the purpose in which it was intended. So keep that in mind, that it is the term over the length of years that the asset is profitably used. Now, is that the same as the normal useful life or the physical normal useful life? No, it is not. Typically, it is shorter. So functional or economic obsolescence may limit a property's economic life. So it could be a functional issue, or it could be an economic issue that limits its life to the economic useful life. Keep in mind that economic useful life is usually shorter than the physical life. So when would you use this? So for those of you who do work in the automobile industry, you know that typically the automotive industry has, platforms. So they'll have a platform that'll last for, 3, 4, 5 years. Because of costs, are now extending that. But basically, at every 3 to 5 years, they will replace a significant amount of equipment in that plant. So the equipment that is changed out every 3 to 7 years, that equipment only has a 3 to 7 year economic useful life. So even though it might physically last 10 to 12 to 14 years, the life is really shortened by the platform life. And if it can't be used for anything else, I would use that as my normal useful life. Medical equipment is the same way. So medical and audio video equipment, the manufacturers build in economic obsolescence and functional obsolescence. They only support equipment for a certain period of time, and then they stop supporting it. So once they stop supporting it, especially with medical equipment in the United States, you can no longer use it once they stop supporting it. So that becomes the economic useful life. So anytime that there's any kind of legislation or any kind of a shortening of the life of the asset, that's when you use your economic useful life. Now, I know you didn't expect to have to think at this point. For you, it's after 5 o'clock. It's probably time for dinner. You're growling, your stomach's growling, you're hungry. Maybe you need a little beverage. But I'm going to give you a little quiz. So based upon what I told you, I want you to decide whether these are functional or economic obsolescence factors. So let's take the first one. Limited production due to a decrease in orders. So decrease in orders, is that something internal or external to the asset? It's external, so that makes it, I heard a lot of economic obsolescence, which is what it is. At least I'm hoping I'm hearing economic obsolescence. The system's running slow due to control system malfunctioning. So if the control system is malfunctioning, that's internal. Now, I know you could potentially say that's physical depreciation, but I want you to choose between physical or economic and just keep those two. So if it's something that's the control system that's internal, that would be functional obsolescence. Product cost more to produce due to an increase in labor rates without the ability to pass on these costs. So it's an increase in labor rates. Is that internal or external? That's external, so it's economic obsolescence. A newer system operates more energy efficiently. That's internal, so that's functional obsolescence. A new competitor enters the marketplace, which lowers the demand from your client. That's a competitor, which is external, so that's economic obsolescence. The income approach of your client shows a value less than the sum of the tangible and intangible assets. Because it's an income approach, it's probably economic obsolescence. The company is selling units, so they're producing them and they're selling them, but the profit margin is dropping because of competition. So if the profit margin is dropping because of competition, that makes it economic. Your client has an older machine that was just superseded by a newer one that can produce 20% more. So if it's just superseded by new technology, that makes it functional obsolescence. Congratulations, everybody passed. So now we're going to go into two methodologies, and I've got like 45 minutes left. I should be able to get through this before I get to the case study. We're going to give you two tools that you can use to figure out how to calculate either functional or economic obsolescence. The first one is excess operating cost. So typically, excess operating cost is functional obsolescence. It can slide over to economic obsolescence, but mostly it's functional obsolescence. Why is this even considered to be an obsolescence factor? And why is this something that you would even consider as a way to calculate it? Well, think about it. If you have two facilities or two pieces of equipment, and this one here is cheaper to operate than this one, as a buyer, you'd want to buy the cheaper to operate, right? Even if it costs a little bit more money up front, you're going to save money going forward. So you're going to want to buy the one that's cheaper to operate. So the one with the less operating cost becomes more attractive than the one with the greater operating cost. So calculating operating costs involves a comparison of two units that are typically doing the same thing. So they're producing the same product, but one is producing them either cheaper or faster or more energy efficient or more labor efficient. So here are some things that you want to look at. Does the new unit have cheaper labor? Does it include less labor, less people? Does it include less labor and maintenance? Do you have to do less maintenance on the newer one? Does it use less supplies? Does a newer unit have less material cost, less energy usage, less scrap reduction yields? So those are things you need to consider. So where would you consider this? You consider this that plants involved in the process industry. So process would be paper mill, cement plants, desalination plants, chemical plants, those kind of things. Plants that are involved in industries that use assets that produce high degree of technology. So if you're in a plant that produces microchips or anything like that, you might have this kind of situation. Older plants that have increased in size over time. So why is this an issue? So this really is not equipment related. You might say that's very much real estate related because you're adding buildings. But if the process and your assets create longer, more harder process flows, let's say if the process should be a straight line manufacturing from point A to point B, but because of the way your building is designed, you've got to take it over here, then you got to move it over here, then you got to go to the second floor, then you got to bring it over here. That costs more to produce because you're moving the piece of equipment or you're moving your product more times into a straight line. That can create a problem for the equipment as well. Plants in which there are a number of identical units. Why is that? Because some are older, some are newer. You can compare the production of them. Plants involved in industries that handle large volumes of materials, and plants that have areas of inactive machinery. So these are all things, if you see any of these, you might be able to use excess operating cost. So here are the steps. How do you actually do this? First of all, you've got to figure out what the cost difference is on a per unit of production basis. I'm going to go through this kind of fast, but then I will show you an example that will hopefully help you figure it out better. You have to estimate the operating expense per unit for the modern facility or the more efficient facility. You have to calculate the cost differential. So what is the difference between what I've got and what the new facility is? Now, if you've noticed, I keep referring to a new facility. So in order to do this kind of calculation, you need your subject, but you also need something to compare it to. Now, the comparable, does that have to exist? I would say you've got more proof if it's actually existing and doing something. But let's say your client is designing a new facility that's going to operate at different capacities and different operating costs. You can use that as well, but it's better if you have some operating history behind it. You have to convert it to an annual expense, and we'll talk a little bit about how to do that. Now, this is something that you don't have to do, I understand, but in the United States, we have something we pay income tax. So you've got to reduce the penalty by the income tax rate. And I understand that you don't have to do that because there is no income tax, but you have to do that. Otherwise, you're overcompensating them for it. And you have to estimate the remaining useful life. And this is, I think, where Ruka was leading, is that you've got to look at how long is this penalty going to be in place. So you have to figure out how much longer is this product going to be produced at this particular rate. So you're doing some projections. And then you have to convert that to a present value. So we'll talk about how to do all that. I'm going to let you read these assumptions in your student manual at a later date because I want to get to the example right away so you can understand how to do this. So how do you do this? How do you do this with employees? Let's say you've got a desalination plant that now takes 20 people to operate. Your client recently built another desalination plant close by. The output of the two plants are very similar. The new plant only requires 10 employees to operate. So the older facility or your subject facility has got a penalty because, again, as a buyer, why would I want to pay 20 people to operate it when I can only pay 10? So therefore, I'm not going to give you as much money for your 20-person plant because it's going to cost me more to operate going forward than a plant that only has 10 operators. So let's say so the disadvantage is the 10 people. So you find an average salary is 188,000 SAR per year. They have to pay some benefits, health benefits, things of that nature, of 56,400 SAR per year per employee. So you add all that up. So per employee per year, you're paying 244,400 SAR per employee per year. So because of the fact that you're paying 10 extra people, you're paying an additional 2.4 million SAR per year. You typically have to drop that by the tax rate, but again, you don't have to do that here because there is no tax rate. So here are some other assumptions. So we're going to assume that the remaining useful life of this plant is 10 years. So we're not going to go into how to assume that at this point, but just assume that you figured that out. You got 0 KSA, so you don't have any taxes. Let's just assume the discount rate is 10%. I'm not going to go into what that is or how to calculate that. That's beyond the course here. When you take a course on the income approach, that will show you how to develop that. So what do? So you take your excess operating cost, which is the cost of those 10 employees. You deduct out taxes, which in the US is 40%, but here is 0, so you don't have to worry about that. And then you have to take 10% for 10 years, a present value factor. So how do you get that? Now, again, if you take a course on how to develop an income approach, they will show you how to develop that. There's also tables out there that will show you what that is. So just assume that you looked at a table and a 10% factor at 10 years gives you 6.14457. So therefore, the present value of paying that extra 2.4 million SAR for 10 years to you is 15 million SAR. So that is labor obsolescence. So what you end up doing is you end up taking that off the value of your plant. Now, so that becomes your penalty. That becomes your, well, it's not really a curable penalty because you can't really get rid of those 10 people, but that becomes your penalty that you take off. So that's based on employees. Now let's look at one that's based on energy. So you've been asked to value a machine that produces 100 units per day. The installed reproduction cost is 550,000 SAR. So the replacement cost, the reproduction cost is 550,000 SAR. So you talk to the manufacturer and they say, well, that's been replaced. We've got a new modern replacement that costs 700,000 SAR. Keep that in mind. Your subject that costs 550,000 reproduction cost uses 100,000 BTUs to operate, while the modern only includes 75,000. So it costs more to build, but it's a lot more energy efficient. Based upon your research, and I have no idea whether this number is realistic or not. I'm basing this off of an example that we use in the US. But let's just say for simple purposes that for each BTU, your client pays 1 SAR. So therefore, on an annual basis, you're paying 25,000 SAR less to operate. You analyze the physical condition of the subject asset, and again, you estimate that it's got an effective age of 6 years. The normal useful life is 15 years, so it has 9 more years of remaining life. So therefore, your physical deterioration is 6 divided by, this ends up being 15, so 40%. Discussions with the operating personnel suggest that a 9-year physical remaining useful life is reasonable. The operating personnel agree that at the end of that 9 years, they're going to have to do something. They're going to have to spend some money. They're going to have to do a lot of cash expenditure to bring it back up to operating performance. So that, again, shows you that the 9 years is pretty reasonable. So what you do is you say, okay, I got 25,000 SAR in energy inefficiency. Again, you look up on the table, we're going to make it a given that the present value factor is 5.75. So today, the penalty is 140, rounded to 144,000 SAR. So how do you use that? So what you do is you start with your replacement cost of 700,000 SAR. So why did we start with 700? We know that the reproduction cost of our unit is 550,000, but the manufacturer says in order to build a different one today, it's 700,000. So again, you're looking at this as the state of the buyer. So you can no longer buy this $550,000 unit. If you were going to buy a new one today, you'd spend $700,000. So as an informed buyer, you should already know that. So you typically start with the value of what it would cost to replace that unit today, not reproduction cost, but replacement cost. In this case, the replacement cost happens to be higher than the reproduction cost. Typically, that's not the case, but in this case, it is. So you take off your physical depreciation at 280,000 SAR. Then you take off your energy efficiency penalty of 144,000 SAR. So you end up with the value of your asset at 276,000 SAR. So that's one way to take excess operating costs. And I showed you two different examples. One is based on labor and one is based on energy efficiency. We're going to give you another tool called the inutility calculation. So what is inutility? Inutility can be either functional or economic. So inutility is whenever the operating level of an asset is significantly less than its rated or design capacity, you got to keep that in mind, the asset is less valuable than it would be otherwise. Such a penalty for inutility can be measured in the loss of value due to rated, design, or expected capacity should be estimated based on the maximum production capacity of the plant after taking into account downtime related to repairs and maintenance. So what that's really telling you is that you got to measure this based upon the utilization, number one, and number two, the capacity of the plant. Well, typically you've got two capacities. You've got what it's rated for, and then you have what it's really doing. And when you actually go through, and I can guarantee you we're not going to get to the case study, but when you go through that, there's an explanation as to what the differences were between the rated capacity and the capacity that I used and why. So inutility is measuring the loss by reducing the capital investment from the rated capacity to the actual operating capacity. So what does that mean? What that means is if you have a unit, if you have a machine that's supposed to produce 100 units per hour, and you're only producing 75, for whatever reason, you're only producing 75, again, thinking of it from the buyer's perspective, would I pay you for 100 units per hour if you're only making 75? No, I'm only going to pay you for 75 units per hour. So this is a way to take that into account. Now, usually it's not, in the past examples, we've talked about 25% loss of capacity gives a 25% penalty. It's usually not that case. So look at historical annual production, look at peak production, not typically the rated capacity. And when you go through the case study, you'll understand that a little bit better. Benefits of using the inutility model. Number one, it's useful when performing a cost approach to estimate value. It's objective rather than subjective. The objective means you can prove it. Subjective means I feel this way. Well, when you do an appraisal and your appraisal gets challenged, it's better to be able to be objective than subjective. Now, there are times when you don't have a choice and you've got to be subjective, but it's better to actually have a calculation behind you to say, this is what I'm doing. It can be a strong indicator of obsolescence. If it's permanent or long-term, got to be careful, make sure it's not something that's just here for today only. Some of the drawbacks. Limitations of the scaling factor, how far to go before it becomes invalid. You got to be careful. And again, that's kind of beyond the scope of this. Scale factor may not be readily available. How to calculate that is beyond the scope of this. And we can do another mini webinar on that. Margins of error, and it's pretty complicated. But here's the, I'm going to skip all that. Excuse me. So inutilities, here's some keys. An inutility can be an indication of functional or economic obsolescence or a combination of both. The relationship is typically not linear, meaning a 25% depreciation, a 25% decrease in production is not usually a complete 25% penalty. Care must be taken since the analysis may or may not account for all obsolescence. And it is best to calculate the most specific utility possible, meaning A lot of times this is calculated on a plant perspective, but it's better if you can figure out, let's say you have a chemical plant that produces 5 different chemicals. Instead of calculating an obsolescence factor and inutility factor for the entire plant, it'd be better to calculate one for each one of those 5 lines or 5 trains of chemicals. The more specific you can get, the more accurate your number is going to be. Now, sometimes that's not possible. You've got to go to the level to which data is available. So maybe it's just at the plant perspective, maybe it's at the line perspective. Get as specific as you can. So here's the actual calculation. So again, we talked about it not being linear. This calculation shows that it's an exponential relationship. So inutility is 1 minus capacity A divided by capacity B to some exponent times 100% to make it a percentage. Now, I know this has gone over in the Taqeem courses. This is covered in the ASA courses. This is a formula that you just kind of have to memorize. The textbook actually goes into more detail than I'm going into, but we're going to go through some brief examples on how to use this. So you've been asked to appraise a production line that has produced 150,000 units per day. Due to customer demand, so since it's customer demand, is that functional or economic? Customer demand is an external relationship, it's an external pressure, so it's economic obsolescence. So because of that, they're only doing 75,000 units per day. You found the manufacturer of the machinery, and it says that they state that they use an exponent of 0.85 when looking at new lines of this type. So that 0.85 becomes an exponent. When you're talking to an engineer or you're talking to somebody at a production plant, they might not know the word exponent. They may use it as, they might call it a scaling factor or an engineering factor. So you might want to use the term engineering factor or scaling factor. So when they're comparing and saying, I've got a line here that produces this amount, I want to build a line that produces more or less, what is the scaling factor? How do they vary? And they will understand that. This whole concept is not an appraisal concept, it's an engineering concept. So they should, especially if they're doing machines that are very similar, that just vary by capacity, they should be able to give you some sort of an idea of what the scaling factor is. So this is how you actually use this formula. So you know that you're producing 75%, you could be producing 150, and you do an exponent there, and step by step, you take 1 minus 0.5, 75,000 divided by 150 is 0.5, to the exponent of 0.85. So you take 1 minus 0.55, and how that's calculated is you take 0.50 and you use an exponent of 0.85. Now, if you're using a Excel, there's something called, there's a little upwards caret. You could use that to come up with that calculation. If you're using an HP12, there's a button that you have to push in order to get that. But again, mathematically, I'm not going to go over how you have to do that, but you have to make sure to calculate be able to calculate an exponent. So if you take the next step, you get 0.45. So in actuality, even though the capacity is 50% less, your inutility factor is only 45% less. Now, I will give you a little hint. When you're using this calculation, when you're doing this kind of formula, most of the time, and I will say probably, I like to say 100% of the time, but it's not always that. But if this factor comes out greater than this ratio, you're doing something wrong. Typically, the penalty is less than the ratio. And the reason that is because typically there's something that's inherent in every asset, no matter what the capacity is. So there's a certain part of it that is the same no matter what they're doing. So the penalty is usually, and like I said, I'd like to say 100%, usually less than the actual ratio. So here's a problem, and I'm gonna give you a problem here is to figure out how to do this. So you've been asked to appraise a production line which is designed to produce 150,000 units per day. Due to engineering modifications, the line is now producing 225,000 units per day, so it's producing more. You found out that the exponent is 0.85. What is the inutility percentage? This is kind of a trick question because there is no inutility because you're actually producing more. So can you actually calculate an inutility penalty? No, you cannot. Inutility cannot be a positive number. It cannot be greater. But what did they do? They did some engineering modifications, which probably meant that they probably added some equipment. So here, I would not just adjust for increased utility. Your reproduction cost or replacement cost is probably higher. So that's where I would look here instead of an inutility penalty. So just kind of keep that in mind. So let's actually kind of tie this together. Let's do an actual problem based upon that inutility penalty calculation. You've been asked to value a production line under the premise of fair value for a business combination. You've concluded that the replacement cost less physical deterioration is 10 million SAR. Based upon your market research, you've concluded that the line could sell piecemeal. In other words, the line could sell, instead of 10 million SAR, if you were going to take that line apart and just sell it for its pieces, you could get about 7 million SAR for it. The line's been operating at 80% of its rated capacity. So based upon your research, you've concluded the exponent is 0.6. Again, where you're going to get that from, that's a whole nother discussion. So based upon this, what is your fair value conclusion? So first of all, you got to calculate your inutility. Well, we're going to do it based on the same thing. Here we know that our production is 80%. So that's our calculation already. We've got our exponent of 0.6. So we use the exact same process we used before. And we end up with an inutility penalty of 12.5%. So what do? So our inutility penalty is 12.5%. We know that our replacement cost less physical and functional is 10 million. We take off another 12.5%, so we end up with 8.7 million SAR. Does that make sense based on the fact that we could piecemeal sell this plant for 7 million SAR? Absolutely, because this number is greater than that. So that makes some sense. So now let's look at it this way. And this is where this next problem is where some people get in trouble. So using the same data as the problem before, but assuming that the line's only operating at 30%, what is the fair value of that line? So we do our inutility calculation. I think you already know where this is going. I'm going to stop there in case you have to catch up with it. So we got a 51.4% inutility issue. So we're saying that there's 51.4% economic obsolescence. So we've got our 10 million SAR. We take off the 51.4% and we come up with 4.7 million SAR. Does that make sense? It does not make sense. And the reason it does not make sense is because you could sell the components of that line for greater than 4.9 million SAR. So therefore, if you have a calculation like this and your client asks you, what is the fair value of these assets? In this case, and I'm going to go back to the previous slide, there's a good opportunity you're at 8.7 million SAR. That makes perfect sense. Under this scenario, and I apologize for going through this again, but if this scenario, the value is not 4.9 million SAR, it's probably 7 million SAR because you could liquidate or you could get rid of all those assets for 7 million SAR. We're actually, and I know I've got another 15 minutes yet, but we're actually at a very good breaking point because the next thing we're going to go into would be the distribution center case study. But what I'd like to do is I'd like to have you go through that in your student manual alone. And if you have any questions, make sure to ask me. But what I'd like to do now is just open it up and see. We've got some time. Is there any questions on anything I've gone through so far? Does anybody want to go back and look at one of the things we've covered again? Best way to do that.
Not at the moment. I don't have any questions, and there are no questions on the Q&A. If you have questions, please post them on Q&A so that they can be answered. But
Yes,
what you
please.
can do is, Douglas, you can do the case study. Don't mind about the time, so
Okay.
that we just finish the case studies. Then we can
Okay.
close. Yes.
As long as we can keep going, as long as we can keep, that'll work.
No
Okay,
problem, no problem.
okay, let's go through this. Let's go through the case study then. It'll probably take another half hour, 40 minutes or so. All right, so this is something that I did several years ago, but it's really fascinating because I was able to bring in a lot of these things that we were talking about here. So it was a distribution center. So what it did was it supplied a bunch of retail stores. It was built in 2002. The valuation date was January of 2010. And so all of the amounts that you're seeing were as of 2010. So here's some facts about the distribution center. It was a little over 576,000 square feet. Total dedicated to the warehouse and the sorter. The sorter is the piece of equipment that actually, so what happens is that trucks come in with the product, they go through the sorter breaks down all the stuff that comes in, and then repackages it for each one of the individual stores. So the sorter basically brings all the stuff in, sorts it, distributes it. Some of it is automatically sorted, some of it is hand packed, and then it goes back out in trucks to all the different stores. These are all the different square footages. It's can handle 150. It was originally designed for 110 stores. It can be expanded to 150 stores, but that would take extra equipment that was not installed. The sorted capacity was 15,600 cartons per hour. Looks like we got a couple of questions, Ruka. Okay, if not, we'll just keep going. Okay. So keep in mind that this is the rating, 15,600 cartons per hour. This was based on a standard size of 20 by 20 by 20, and this was the rated capacity by the manufacturer of the sorter. Now, because of a lot of factors, no sorter will actually ever operate at that. So if you use that, you're actually going to overcompensate for the valuation. And you don't want to overcompensate for the inutility. So what I did is I took 3 years of data, and I looked at the data, and I looked at the data on a monthly basis. And I also talked to the client personnel, and I figured out what is your busiest times of the day, and it's typically just before and after school season and just before and after Christmas. So what I was able to do is I looked at the capacity within that time frame, and under basic 2 shift per day, 5 day per week operation, I figured that roughly they were at 49% of that. So in other words, the maximum they've ever run on a continuous basis is about 49% of that 15,600 cartons. So that is the maximum capacity this plant has ever run. So instead of using 15.6, I used 49% of that as my beginning point because that is what they were actually operating at. They operate 5 days per week. They had 193 employees, which some of them were part-time, so it ends up being 166 full-time equivalent employees. There was a total of just about 13 miles of conveyor. There were 6 sorters. The subject distribution center was considered old style. They actually improved and made some different sorters. So what I did is I found out there was 2 newer distribution centers. Our subject is here, built in 2002, handled 110 stores, roughly 576,000 square feet, had 13 miles of conveyor. There were 2 distribution centers. Again, I did this valuation as of 2010. So the 2 most modern ones they built were 2008 and 2006. The 2008 model was designed for 150 stores, so it's got 40 more stores. Look at how much smaller it was. It was only 55% of the size. It had a lot less conveyor. Well, what does that mean? That means that there's a lot less cost involved, right? The one that was built in 2006 has got the same amount of stores. Look at that. It's a much smaller location. It's got a lot less conveyors. So I was able to use these. So instead of doing it as a piece by piece by piece of equipment, I was doing it as a valuation of a sorting system. So here are some, the report that I wrote on this was over 100 pages. I had a lot of detail, a lot of graphs. We're going to bring this down and give you just some very basic facts here. The subject distribution center had mostly manual receiving lines, which means stuff came in, people had to literally grab it and take it off as opposed to automatically being sorted. They had 4 single automated print and apply lines. Newer technology uses dual automated. So in other words, This one had one single line that print and applied labels. The new ones have two of them. It was able to do two wide. The 2008 distribution center had 10 of these dual systems. They can service two doors and cut down on manual handling. So the benefits of this, of the print and apply, is reduced labor requirements, increased accuracy, and increased speed. Updating the subject distribution center would take a significant amount of money. And they also had narrow collector beds, which allowed for only one of every 4 receiving lines to load at any time. So for every 4 loading lines, one of them could only operate at a time. The newer systems had where they were able to allow at least 2 doors to operate at the same time, which gave you increased accuracy and increased speed. Now, again, how did I find all this out? I spent a lot of time at their corporate headquarters. I talked to the people that designed these lines. I did a lot of investigation. The shipping sorters installed were very different layout. The subject had, and again, this data is all going to be in your handbook, so you can look at it in further detail. But they used 4 sorters that serviced 110 shipping docks. These were in an L-shaped configuration along 2 of the walls. The newer designs have 2 of them that run parallel to each other, and they crisscross, which made it a lot more efficient and a lot less conveyor, a lot less floor space, a lot more staging of product, a lot less backup of the sorters. So with our sorters, because of they were L-shaped, there were areas where the packages got blocked and they couldn't move. So once something happens, the entire line stopped. With running 2 sorters parallel to each other, they have a better shot at keep going. Again, they were straight lines as opposed to doing an L, which means less product droppage and things of that nature. So there's a lot more efficiencies. The scanning tunnels were obsolete. So what happens is that the product would come in, it was all barcoded. In order to figure out where it went, it would go through a scanning tunnel. Well, the scanning technology at the old plant, what I was doing, was pretty much obsolete, and what they call no reads or misreads was pretty high. The new scanning technology was a lot more efficient, but it costs a lot of money to implement. Newer systems use a graphical system monitor interface, which basically what that does is that was a computer system that significantly sped up the system and also created less energy usage. So I know I'm throwing a lot of data at you here, but I just want to give you an idea on some of the things I went into and what I investigated. I'm kind of zipping through this because I really want to get into the calculations here. So based upon the data that I did, remember I told you earlier that I figured that the maximum capacity they could run at was about half of 49% of the total. So we're saying that the maximum capacity was 7,644 cartons per hour. Well, the time that I was there as of January of 2010, they were only running at 38%. So 38% of the 15,600, keep that in mind. So they were running at 5,928 cartons per hour. So if I take the 5,928 divided by the 7,644, we are actually running at about 78% of the potential capacity. So again, if you take that 5,900 divided by the 15,600, that's more like 30%. You'd be overcompensating, and you'd be giving your client, and this is for tax appeal, I would be giving my client a benefit that really wasn't there. There are other obsolescence factors, but we're not going to go into that. But just keep in mind that it was 78% of it. So we're not going to go into too much of this, but let's just say that I showed you earlier that the 2 stores that they built, the 2 distribution centers that they built later were a lot more efficient and a lot less capital involved. And here's the cost of the subject distribution center. So total, this is all the breakdown of the mechanical hardware, the controls, the engineering, all of that came out to about 54.5 million SAR. So that is our subject. That is the replacement cost of our subject today. Now, again, I was able to get to the equipment manufacturer and get that. The 2006 distribution center, which was built, remember, it served the same amount of stores. This is the replacement cost as of 2010. This is not the reproduction cost, but so what I did was I asked the original equipment manufacturer, take what you had at the old store, tell me what it costs in 2010. That was 54.4 million SAR. Give me that 2006 distribution center. Tell me what that would have cost in 2010. That was 43 million SAR. So there's quite a bit of difference there already, right? You're talking quite a bit of difference in the cost of that facility. So the additional 11 million SAR is considered excess capital cost. Remember, excess capital cost is functional obsolescence. So that is that you're taking it off the top. So therefore, the replacement cost is 48,000. They did have some additional costs that they spent that other distribution centers did not have, which is another 5.4 million SAR. So I added that in. There was an area that they had that was no longer being utilized, so I subtracted off the equipment. I'm not going to get into too much detail there. But adding in the applicable sales tax, we came up with about 5.6 million SAR. So let's get into how did I start depreciating that then? First thing I did is I considered physical. Remember, we have to consider physical, functional, and economic. So there's a couple different things I considered here. First of all, I considered that there's physical depreciation and deterioration due to its age, and they needed to replace obsolete equipment. Replacing obsolete equipment means cost to cure. Remember that? We talked about that earlier. So in order to, there are some fixes in the system that they could do. So we're going to show you how we compensated for that. We figured out the normal useful life. Let's just say we figured out the normal useful life of these assets is about 16 years. How did I come up with that? Well, I knew from the equipment manufacturer that there's a physical life of 15 to 20 years. I looked at a bunch of things, including how often do they build and close these facilities? How often do they retrofit them? How often do they replace the systems? And I arrived at a 16-year normal useful life. So we talked about this already, that you got to replace some obsolete equipment. So they were operating for about 7 years at that time. There's no significant maintenance. I mean, they did maintenance on it, but it wasn't significant, so it didn't extend the useful life of the assets at all. So therefore, we've concluded that the normal useful life it was 16 years. The chronological age was 7 years, and based upon the fact that the overall expenses were fairly minimal, they didn't really do a lot of extra additions, we concluded that the effective age and the actual age were the same. So in other words, what we did is we just said, okay, 7 years divided by 16 is 44% depreciated or 56% good. Some of the other things we looked at is, remember, we talked about some of the things, the sorting tunnels and the print and apply tunnels. So we figured out how much that would cost to replace today. So we came up with a total of $1.5 million that was curable. So we got two different factors here. We've got curable physical depreciation, which is replacing these units with better units and upgraded systems. And we also have our physical depreciation based upon an age life analysis. So if you remember, we started out with 51.6 million SAR. The first thing you do is you take off your curable depreciation. So the first step, if you got curable and incurable, let's consider that this 44% is incurable. It's just because of wear and tear. You always take off your curable first. Remember that. So you take off this $1.5 million of curable, and then you end up, and you take off your 44% of incurable, so you end up with $28 million. Am I done? I'm done with physical, but I've got to look at functional and economic depreciation. So the primary functional obsolescence was due to excess capital cost. So we already took that into consideration up front. Remember, we already took that deduction. However, there's also functional obsolescence in the form of excess operating cost in the area of excess labor, because there's more people that are operating ours. And there's also excess electricity cost because the new system is approximately 6% more efficient. And when I say more efficient, it uses roughly 6% less electricity. Now, I know that's a small number, but again, depending on what your purpose is, you might want to take that into consideration. So based upon an analysis of the expenditures, we concluded that it costs $963,000 to operate the system. So in other words, it costs them 963,000 SAR per year to operate the asset from an electrical standpoint. So that's what they spent annually to operate it. So we know that the new unit is about 6% more efficient. So therefore, if we take 6% off of that, we come up with roughly a $58,000 per year penalty because of the fact that the new unit is 6% more efficient. The unit that we're looking at has 166 full-time employee acknowledgements. The new unit only needs 160,000 or 160 full-time employees. So therefore, we came up with another penalty cost. So we got a penalty, an annual penalty rate of electricity of 58,000 SAR per year. We've got a penalty of labor rates of 486,000 SAR per year. So we add those together and we came up with 544,000. So in other words, what this is saying is that a new operating center, a new distribution center would cost roughly 544,000 SAR less to operate than our unit. So we know that for this case, because it was in the United States, we had to take off the income tax rate. So we end up with 204,000 SAR. And at 10%, and I got that rate of return from my client, they expect a 10% rate of return on their investments. The present value factor was a given at 5.76. I looked that up on a chart. So therefore, you take the present value and you end up with a roughly about 1.9 million SAR that you need to subtract off. So we took our replacement cost, less physical, and we took off one obsolescence factor, which was the difference in the energy and the difference in the labor. But we also have some economic obsolescence penalty that we have to take off. In this case, the difference is an external factor, which is the pricing charged by the utility. So I'm actually taking off twice for power distribution. One time because the new one is actually 6% less efficient. And secondly, because where this particular facility was operating, there was a premium paid for electrical utilities that is not paid at their other facilities. So again, what I did is I figured out what the differences is there, and we took a penalty off. So let's just assume that for now, because I want to get into this one. This one's kind of interesting. So remember I told you that there's something called that exponent or the scaling factor. You could actually calculate that if you have the right data. So in this case, I happen to have really good data. So I know that our store has a capacity of 150 stores. The 2008 unit has a capacity of 150,000 stores. These are the replacement costs for those two particular units. So to do a 150 store distribution center costs about 57 million SAR. To do 110 stores costs a little over 43 million SAR. So we ended up with a exponent scaling factor of 0.91. So how you actually calculate that, I'm not going to get into that, but if you actually get into, if you look at the valuing machinery and equipment put out by the American Society of Appraisers, they will show you step by step how to calculate that. What you need to do is you need to take the ratio of these two, and then you have to calculate some natural logs. And if anybody's interested in that, I can get you the page of the book that shows you exactly how to do that. Ruka, I'm not sure whether the Taqeem data goes into how to calculate that or not. They might, but I know the ASA textbook does. So using this data, I was actually able to calculate my own exponent, which actually was very valuable. So based upon that, and since based upon the fact that the SDC was operating at 78% of its actual capacity, we were able to come up with a 20% penalty. And again, remember, we're taking the 78%, which is our rate, our actual versus rated. And we've been through this calculation a couple times before. So in actuality, what we did was we took our physical, we took our replacement cost, we subtracted off our physical, we subtracted off our functional, and now we're subtracting off another 20% for inutility. So overall, we ended up with a little over 20 million SAR in value. And actually, I got through that a lot quicker than I anticipated. I know I zipped through that kind of fast. Like I said, when you get your student manual, it'll all be detailed out for you step by step exactly how I did it here. Once you get your student manual, look it over. If you have any questions, feel free to contact me via email, and we will set up something to answer your questions. So, Ruka, it looks like we've got some questions.
Yes, Douglas, we have got some questions. First of all, I would like to give Osama. Osama, he has raised his hand. Osama, can you speak? I'm giving you. Osama, are you still there?
Okay, I see a hand up.
Yeah. I've given him permission to talk. But unfortunately, maybe he's no longer there. Okay, there's another question from Abdullah. Is this applicable for airplane? Maybe in the valuation of airplanes, the calculation of economic obsolescence and functional obsolescence. I think that's what he's talking about.
Okay. So the answer to the question is yes, this is applicable for aircraft. From an you would not have inutility, so to speak. What I would use if you're doing an aircraft valuation, there's a couple different tools you would use. I would use the market comparable. You would do like you would do, anybody who does real estate knows that you do like matched pairs where you'll come down and say, here's my physical depreciation on these assets. Here's my, and what's the difference? The difference is either functional or economic. So I would do something like that and come up with a market-based obsolescence penalty that in the case of an aircraft is probably a combination of both functional and economic. So that would be very a valuable tool for that. Also, if the aircraft is a primarily a leased aircraft, and Boeing is a very good example of this right now. Boeing's had a lot of issues. So therefore, I would assume that there's some economic impact on the value of a Boeing aircraft that is probably being applicable based upon the fact that there's so many problems with them right now, that I would guess if you try to go to the marketplace and try to find one, that there's going to be a decreased, there's a decreased demand for them, and there's also going to be a subsequent decreased value for them. Now, how you actually calculate that, if you can get one or two good sales, then you can maybe calculate a market-based one. But if it's like a rental situation, maybe you could do something with the income approach and say, okay, because of the fact that Boeing has had such an issue, they can't lease their assets for as much as they used to, and you can calculate it based on a cash flow analysis. I know when you do aircraft, you do all three approaches to value. You do a sales comparison, you do a cost approach, and you do an income approach. So in that case, I think the income approach and the sales comparison approach would be the best way to calculate obsolescence.
Okay, that's fine. I think he's answered on that one. Then Abdulaziz, he's saying, I would like to know how is the case of over utility. I mean, in the case of increased production due to some modifications. Suppose something has got an optimum capacity of, say, 2,000, but it has been modified. Now it's producing maybe 2.5,
Okay.
2,500.
Okay.
So, yes. How do you handle that?
How do you handle that? Well,
Yes.
that's similar to the one example we had earlier, where it's really, it's called, I mean, I loosely use the term negative economic obsolescence. What's going on there is you're not adding utility from a utility calculation. What I would do is I would look at the cost, and I would look at the cost to put that line into production. So I would argue that the value is not increasing at the utility standpoint. It's increasing at the top of your calculation. So they're spending money and doing something at the replacement cost level and the reproduction cost level. So that's where your increase is going to happen. Your increase is going to happen at the top of your calculation, not at the bottom. So if you go from 2 million to 2.5 million, there's going to have to be some capital expenditure that's creating that. So I would figure out how much of that needs to be added back in at the top of the calculation, not down below. So I would add that into your replacement cost or your reproduction cost. And is it a dollar for dollar? Let's say if they spent, let's say if you calculate a replacement cost of 5 million SAR, but then they added another million SAR to make it up to that other capacity. Is it you added another $1 million or $1 million SAR? That may or may not be the case. There's another way you could do that, which is called the cost to capacity calculation, which is part of the training materials that I know Taqeem does have.
Yes, we do.
So that's another way you can calculate that. But again, that's calculating the replacement cost or reproduction cost, not utilization. So I would do that at the top end of the calculation, if that makes sense. If that doesn't make sense to you, please contact me and we'll go through it in better detail.
That's fine. I saw Shaik. Are you still there? Oh, yes, lowered his hand. Let's hear from this. There's someone who said, can you please send the name of the book and page number?
Okay, the name of the book is Valuing Machinery and Equipment, published by the American Society of Appraisers, and I'm not sure the exact page number, but there's a chapter on the cost approach, and within that cost approach is the way to calculate that exponent.
Yeah, I think it must be chapter 3 or 4. I'm not sure of the chapter, but it must be chapter 3 or 4. Okay, let's another question that I have here.
Just 1 second. I'll tell you the chapter number in a second.
Okay.
It is you are correct, Ruka. It is chapter 3, which starts at page 32.
Chapter 3, yeah.
And calculating the let's see if I can find it real briefly. Probably not.
I have a hard copy as well of the 4th edition.
Yeah, I've got it both hard copy as well as on my computer. I cannot find the exact page, but it's somewhere in chapter 3 of that book.
Chapter 3 of that book, yes. Yeah, I recommend people to buy this book. It's almost like $95 a soft copy. You just buy a soft copy and keep it for future.
And then you can. The nice thing about the soft copy is you can search it.
Yeah, it's searchable.
There's a search factor. Now, I will tell you that this book is potentially going to be revised in 2025 or 2026.
Okay. Because myself, I've got the 3rd edition and the 4th edition.
I'm sorry, what was that, Ruka?
I've got must be 1st edition.
Okay.
3rd edition and 4th edition.
There you go. So but don't make that stop you from getting the 4th edition, because this is a very valuable tool. And like Ruka said, it's best to get it soft copy, because then you get it immediately and you can search it, and it's a great tool.
Yes, wonderful. Okay, I've got a case here. If you know from the production manager that the machines are capable of reaching the maximum production capacity designed for the machines, and that they are operating the machines at half their current capacity due to the company's inability to sell products due to high management or high management costs, I'm sure, are the obsolescence factors applied to these machines. And then he said, if you know that the machines have been tested and are in good condition and have reached design production capacity, and there are no new technologies for this type of machines, and also that there are no new laws or legislation that restrict production, and there is an active market for the products produced by the machines.
Okay.
So he's saying it could be a high management costs or inefficiency or some sort, but it's relating to management. So their inability to sell the products. So as a result, they are working at lower capacity.
If that's the case, then it's a very company-specific economic obsolescence. Now, the thing missing from all of you, and by the way, that's a great, I'd love to do that case study. That's a great case study. You got a lot of details in there. The one thing you got to ask yourself as a professional valuer is how specific is this piece of equipment to this company? And if you're valuing it for that company, then yes, there would be that somewhere around the 45 to 50% inutility factor that you would apply to that piece of equipment. Now, if that's a very specific piece of equipment that's doing a very specific product that can't be used for anything else, then I'd be more inclined to hit it with a larger penalty. Now, if that's a piece of equipment that somebody else could buy, I would stop the penalty at what somebody else could buy that piece of equipment for. So the more specialized the piece of equipment is, the more specialized the product that it's making, the more applicable larger penalties are, if that makes sense to you. Because really, if I've got something that I'm making a product, and this product can only be made on this machine, and this machine cannot make another product, what is the liquidation value of that machine? Essentially, it's scrap metal, right? So you've got a lot of movement between fair market value and scrap metal. So you got to kind of look at what is the best, what is the most typical, and within purchase price allocation, they say, what is the typical marketplace? What is the market participant going to do? So you've got to look at it from that standpoint. If there's another company that can make it better, then you might only hit it with a 30 or 40% inutility penalty and not the full amount. So you got to do a little bit of investigation on that standpoint.
Okay, thank you. Another question, I've done a translation. What is the method for calculating hours of experience in exchange for attending this meeting? What is the method? Oh, maybe it's talking about hours of.
Yeah, that's something I can't answer. That's a key question.
Okay, that one is done by membership. This course we are giving 3 hours, 3 experience hours for attending. So that is the basis of calculating that is done by we've got the CPE policy. If you go on Takim website, there is a policy if you go on the tab written laws and legislation, you find a continuous professional education policy. Then you can read more information about experience hours to do with all the CPEs of this nature. That's fine. And let me go to another question. I think there's another question. How do you investigate the actual productivity?
I'm sorry, what was the question again, Ruka?
How do you investigate the actual productivity?
Oh, okay. How do you investigate actual productivity?
Yes.
Well, okay, so if they're making a standard product, now this doesn't work for like what I call a job shop or a machine shop that's just doing a lot of different products. But if they're making a particular product, every manufacturer will have their production history documented. They do that for a lot of different reasons. They do it for sales reasons. They do it for maintenance reasons. They do it for production tracking. So they will have that data. So what I usually ask them is I say, my first request is there someone in your facility or in your organization that will be able to tell me by product what your production is on an annual basis, what your maximum production could be, and what your production was for the past 3 to 5 years and the next 3 to 5 years? Is there somebody that could do that? Now, obviously, you do not want to get a spreadsheet that's got 10,000 numbers on it and not know how to analyze it. So I ask them for summaries by year. I ask them, and they say, do you want it by plant or by line? I will try to get it by major production line if I could get it. But there's usually someone that tracks that. Now, when you're doing something like a cement plant, they'll probably track it by tons per year or tons per hour. If you're doing a chemical plant, it'll be either tons or gallons or something of the product per line or something. There's usually somebody that tracks that. You just got to find the person.
Okay, that's fine. Thank you. I'm going to give you another question. I've just crafted this question.
Okay.
In terms of like environmental control regulations, Sometimes like a furnace, maybe a smelting furnace or of any kind or any nature. Sometimes the environmental agents can give you a penalty, right, for emission of some sort. And then they give you like 2-3 years to rectify that.
Okay.
So how do you handle it when you are calculating economic obsolescence?
Okay, you're talking about how do you handle the penalty?
Yes.
How do you handle the fine?
In terms, yes, the fine, in terms of the, are you going to reflect it as an obsolescence, economic obsolescence?
Yeah. So let's okay, you said let's say you've got the penalty for 3 years.
Yes, 3 years. They'll just say, we are charging you 150,000, right? And we expect you to resolve this emission challenge.
Okay.
Right,
So
to
how
upgrade
so
the
let me ask you
system.
this, Ruka. How are you going to fix the emission challenge? You have to spend more money, right?
Yes, definitely.
Okay. So what I would do is I would handle it 2 ways. The first one is your cost to cure. So whatever that penalty is, that becomes an automatic. So let's say that it costs you $500,000 currency to fix. That $500,000 is an automatic penalty, even if you haven't spent it yet, because obviously you haven't spent it yet, but it's something you have to spend, right? So yes, I would definitely take that $500,000 off as a penalty right off the top, no questions asked. I would take that 150,000 and I would take, so your total cost is 450, right? Because it's 150 per year for 3 years. I would discount that back to 1 year, and I would take that as the penalty as well. So yes, there are situations where the penalty is going to get very large very quickly.
Yeah, that's true.
But as a buyer, and that's an excellent question, Ruka, as a buyer, you have to consider that because you have to spend all that money. So I'm going to pay you less. I'm going to pay you a lot less because I have to incur those costs. So that's what I would do. I would take it 2 pieces, and you're not double counting because you're taking 2 different penalties. Now, granted, if you spend the $500,000 now, you might not have that 450,000.
Yes.
So you got to decide: are you going to spend that then? Or are you going to spend it now? But let's say if you're going to fix it in 3 years, I would take the $500,000 penalty plus take the current value of those 450,000 right now. So you take 2 penalties.
Okay. So you reflect both costs at the same time in your valuation?
If my valuation's here and I've got 3 years to go forward, and we're going to assume that's all going to be the same going forward,
Yes.
then yes, I would. Now, if you're in year 2, I would only take 2 years of the penalty, and then the $500,000. If you're in year 3, you're only going to have to incur that for 1 year. So you got to figure out where you are in that time frame. If you're in year 3, you're not going to take a penalty for the stuff that happened before, but you're going to take a stuff that's for the penalty going forward. So wherever you are, 1, 2, or 3 years, you take the penalty for what's going ahead of you, not what's behind you.
Okay, that's fine. That's
Okay.
fine. Right. Maybe let me come up with another one. Excess in capacity cost.
Okay.
I think it's derived from the difference between reproduction and replacement costs. Am I right?
Okay. I'm sorry. Which one was that?
Excess capital costs.
Yes. Excess capital cost is reproduction cost minus replacement cost gives you excess capital cost. And again, the whole, go ahead.
Okay, right. In the case where the replacement cost is more than reproduction cost, how do you handle that?
Okay, that's a great question, because in some cases, and especially in today's marketplace, post-COVID, that happens a lot. And so if that's the case, there is no excess capital cost because the cost actually went up. So in that case, you don't take any penalty. You start with the replacement cost, which is higher, because again, thinking about it from the standpoint of a buyer, if I'm going to go buy a new one, I have to spend more money. Now, granted, when you spend more money, and this is a question that I always ask whenever I'm getting replacement costs from somebody, is this piece of equipment still being made? Yes or no? That's an easy one.
Okay.
Does the piece of equipment that's being made look exactly like the one that's mine, or is it better? That should be a pretty easy question. If it's better, this is where things get tough. Why is it better? Is it more energy efficient? Does it take less power? Does it make more product? That's when you have to start going through that. And in some cases, usually, not always, but usually, if the replacement cost is more, there's some reason it's costing more. It's probably more energy efficient, makes more product, does something better. So then you take those penalties out underneath instead of at the top. Now, if you know, again, right now, costs are going through the roof for everybody. So the replacement cost might just have gone up and there's no betterment. So in that case, you just have a higher replacement cost to start with.
Okay. So in your calculation of the opinion of value, which one would you base on, particularly the higher replacement cost new or the reproduction cost, which is low?
I would start with a higher replacement cost.
With a higher replacement cost.
Yes, because again, you have to look at the typical marketplace. What's going to happen if I go to buy one, I have to pay more money.
Okay.
I have no choice.
Excellent.
Yes.
Excellent. Okay, thank you very much. Right now, I think looks like there's a question. Yeah, there's a question.
Okay.
From Louis. Economic factors can increase value. Why also take it as obsolescence?
Economic factors can see that. Okay, this is okay. Excellent question. Don't mix the economy and economic obsolescence. Economic value can increase the value of a product or an asset. Remember early on, I said economic obsolescence is extremely variable. It goes up and it goes down. What you're talking about is a situation where you don't have positive economic obsolescence. The economic obsolescence that was there disappears. So you might have a time when all of a sudden something is worth more. That's called a market driver. That is not an economic obsolescence. That is a market influence or a market driver that causes that to happen. So again, I don't know exactly what's going on in the Middle East during COVID, but here during COVID, used values of machinery went way up. That is not reverse economic obsolescence. Those are just market adjustments or market drivers that cause that. So you've got to call them something different. You can't call it economic obsolescence. And I've gotten to a situation where I got into an argument with an auditor because on my model, I've got economic obsolescence and some of them were negative. And so they said, you can't have negative economic obsolescence. And I said, I understand, but it's a market adjustment. But he goes, well, then call it that. And I'm like, okay, it's the same thing, but you got to be careful what you call it. It's a market adjustment, not negative economic obsolescence.
Ah, okay. Right. Thank you very much, Douglas. We no longer have any questions. Thank you for an excellent presentation.
Thank you, everybody, for attending. I really enjoy you spending so many of your after hours with me. It's always a pleasure. So it's an honor. Thank you very much.
Okay. Thank you, Basim, for being the translator for us.
Basim, very much appreciate
this webinar. And thank you, everyone, for joining. Our session ends now.
Okay. Have a great day, everybody. Thank you.
Thank you. Goodbye.
Bye.
Thank you, Dougie.
Thank you. Okay. Nice talking to you again.
Okay, later.
Oh, there we go. All right. So how do you think it went?
Yeah, it goes well.
Okay, good. Good.
Okay, bye.
Okay. All right. Have a good day. We'll talk to you soon.
Okay, say later. Thanks.